Hi everybody, my name is Joshua Jensen and I'm here to review with you what a mortgage is, how to use a mortgage, and the different types. Now, first and foremost, what is a mortgage and how can you use it? A mortgage is essentially the loan you get from the bank or from the mortgage company that you are essentially paying off your home through them, and the more you pay off, the more percentage of the house that you own. Now, how can you use a mortgage? There are three different ways in regards to how you, as a consumer, can utilize a mortgage. Before anything else, you need to purchase your home. Now, this is a process of going through, maybe going through a realtor, maybe not, and finding a house to start owing and to start owning. Once you've taken care of this first step of purchasing your home, you can access several different ways to improve your current financial situation or to make your home that much better. The second thing you can do with a mortgage is you can access the equity in your home to do several different things. Now, what equity is, it's the difference between what your home is valued or the appraised value and how much you owe the mortgage company. For example, if you have a home that you have a mortgage balance or you owe the mortgage company $200,000, but your home appraises for $300,000, that means that the equity you have in your home is $100,000. You can take advantage of doing a refinance, get access to the equity in your home to maybe do some home improvements, maybe pay off some debt, maybe go through and start a fund for your kids for education. You have the ability to access essentially that $100,000 to do with whatever you see fit. Now, the third primary reason that you would use a mortgage is by reducing your monthly payments on the mortgage itself or putting yourself into a position to pay your home off even faster. You can do that by reducing the interest rate, reducing the term, or changing the term. Now, there are some words or some terms when utilizing your mortgage you want to take into consideration. The first, and one of the most important, is interest rate, or also known as rate. This is how much money the bank is going to charge you in interest that you're going to pay over the life of the loan. Speaking of life of the loan, the next word I want to talk about is term. When either refinancing or purchasing, you want to focus on rate, you want to focus on term. This is going to determine how long it takes you to pay off your house. Is it 15 years, 20 years, 25 years, 30 years? That term is going to set you up for what your payment's going to be until you either refinance or you pay off the house. Rule of thumb, lower the rate, lower the payment, lower the term, higher the payment, because you're trying to pay off the term, you're trying to pay off the mortgage in a faster time frame, which increases how much money it's going to require every single month. And then the third thing is mortgage insurance. Now, mortgage insurance is not the same type of thing that you would get from your Allstate agent or your USAA agent. Mortgage insurance is put in place from your mortgage company to protect them. Mortgage insurance does not protect you, it protects the mortgage company. What it does, it's a fee that is charged either at the start of the loan up front or a fee that's charged through the life of the loan to take care of the mortgage company in case you cannot or you default on your house and go into foreclosure. Now, we have the terms: interest rate, term, what mortgage insurance is. These are three key factors that you need to take into consideration when utilizing your homeowner benefits. Now, the types of loans that are out there are plentiful. Now, I want to focus on three of the popular and primary uses of loans. The first one is a conventional loan. This is your standard loan that everybody typically thinks of when getting a house. It's very, very basic, very, very set in terms of structure and requirements. It is also in my opinion, a little bit better of a program than maybe one or two of the other ones that we're going to talk about. It is typically good for people with good income, good credit. The next type of loan is an FHA loan, or a Federal Housing Authority loan. This is specifically tailored to people buying a home for the first time that may not have a lot for down payment, or maybe people with lower credit that are looking for a government-backed loan, which the FHA is, a government-backed loan to make home ownership a little bit easier, but has a little bit different rules and guidelines. And then the third one is a VA loan, or a loan through the Veterans Administration. Now, the first one is not a government-backed loan, which means the rules and guidelines may be a little bit more strict than the FHA loan or the VA loan. These are government-backed loans, which means if that loan goes into default, they do have a little bit additional cushion with being backed from the government, where guidelines are a little bit easier to meet, and maybe somebody who doesn't qualify for a conventional loan does have the ability to qualify for an FHA loan. Or if you did serve in the United States military, a VA loan is going to be your best option 95% of the time. Now, as I mentioned at the beginning, purchasing your home is the first step. Now, I want to go over different guidelines and different rules to see which one may work best for you. So, we're going to discuss conventional loans, VA, and FHA loans. Down payment on a conventional loan as well as an FHA loan, you need to have a minimum of 5% down. Now, that means on a $200,000 house, you need to put $10,000 down at the purchase of the property. VA loans, however, they do not require any down payment, which makes a VA home loan very, very advantageous if you are purchasing a house. Next, mortgage insurance I talked about earlier. This is why I did discuss it. On a conventional loan, you are required to pay mortgage insurance set from the mortgage company up until you have 80% equity in the home. On a $200,000 home, that means that you need to get your balance to $160,000, and then the mortgage insurance on that drops off. On a VA home loan, they do not charge monthly. They do, however, charge an upfront fee called the VA funding fee. Now, the VA funding fee, if it's your first time buying it, is 2.4% of the loan amount, 3.6% if you purchased a home previously. However, that fee is waived if you do receive disability from the Department of Veteran Affairs. And then FHA home loans, as I mentioned, this is a little bit more, I guess, it's easier to obtain regardless of credit score and income. However, it comes with a price. On an FHA home loan, you are being charged 1.75% of the loan amount up front, as well as almost a half to 1% of the loan amount over the year. So what that means, on a $100,000 loan, they're going to charge you $1,750 up front to get the loan, and then over the next, every single year, you will pay, let's say in this case it's half a percent up front. You would pay basically, $875 over that year for mortgage insurance. It does not drop off, and it's there for the life of the loan. That's why FHA home loans are great for starters, and then once they go through and are able to maybe go to a conventional loan, they typically switch to that. Loan to value again is same as equity. It's what you owe versus what your home's appraised for. Conventional, you can go to 95%, which is why the 5% down payment is required. VA loans 100%, so you could put nothing down, and FHA is also 95%. However, with an FHA home loan, if you don't have that additional 5%, there are loans and assistance programs out there to help you obtain that 5% in a second loan. Now, unique prerequisites. Conventional loan, there's none. FHA home loan, there's none. However, in order for you to obtain a VA home loan, you do need to serve in the United States military and there are a few requirements that you need to hit in order to do so. So that's the purchase side. Once you have your home, you can refinance in two different ways, as I mentioned, doing a cash out refinance or going through and just doing a rate and term. On a cash out refinance, there is no mortgage insurance on a conventional loan. The reason why is they have a maximum loan to value of 80%. So because you're already at that 80% limit, they do not charge mortgage insurance. VA, same as purchase, it's 2.4% of the loan amount. So it's 3.6% of the loan amount. So $3,600 for every $100,000 you borrow. On a FHA, it's the same as a purchase. 1.75 up front, plus whatever the mortgage insurance every single month comes out to be. As far as loan to value, in order to obtain a cash out refinance on a conventional loan, you need to have at least 20% equity after you get the cash out, 90% for VA, and 80% for FHA. Refinancing, they may or may not require an appraisal. Conventionals, they may or may not, depending on what the parameters of the loan turn out to be. On a VA, you always will. On an FHA, you always will. So getting cash out, maybe to pay off debt, do home improvements, put money aside for a retirement account, that would be the process you do here. And depending on which category you fall into, you may be able to obtain going from an FHA to a conventional if you purchased, VA to conventional if you purchased. I don't recommend ever going from FHA or from VA to FHA. Now, just simply dropping your interest rate and dropping your term, this is a little bit different. On a conventional loan, they do require mortgage insurance, just like on the purchase, if you're above 80% of your home's value. They do allow you to go to 95% value, so if it's a $100,000 loan, you can have a loan amount up to $95,000. Appraisals on conventional loans, they may or may not be needed, just depending on the information that they have available in the area you're purchasing. And then on a conventional loan, on a refinance, they are going to need you to qualify based on what you're making monthly and what income you are bringing in every single year. VA home loan, mortgage insurance, it's upfront again. However, instead of that 3.6% like it is with the purchase, or the 2.4 or 3.6% like it is with the purchase, and then the 3.6% with the refinance, it's only 0.5%. So what that means is $100,000 of your loan amount, you have to pay essentially $500 every time you jump up $100,000. Now again, this caveat is waived if you are receiving disability from the VA. FHA, nothing's changed. Their mortgage insurance is standard across the board. 1.75% up front, and then anywhere from 0.45% a year to 1.05 per year. Just depends on the equity, depends on the term. On conventional refinance, which is why the appraisal may be needed, they do allow you up to 95%. However, with the government-backed loans, there really is not a loan-to-value requirement. They don't really come into play, which is why you may not always need an appraisal on a conventional. You don't need one on an FHA or a VA, nor do you need to provide income documentation on government loans. If you're making your payments on time, logic dictates you'll be able to go through and make payments on time at a lower monthly payment. And then some things to consider when going through and when utilizing your homeowner's benefits is what type of loan can you qualify for? Can you qualify for a VA loan? Can you qualify for a conventional loan? Can you qualify for an FHA home loan? Those are all things you want to discuss when going through and when figuring out what type of loan you want. What do you want your payment to be? This is important in regards to how much cash you want to get out, how big of a home you want to purchase. If you want to or you don't want to decrease the term to pay it off faster, what do you want your mortgage payment to be and how much do you want to add? And then finally, if you are purchasing a home, do you want to use a realtor? keep in mind, realtor fees do not pertain to somebody purchasing the home. Realtor fees are strictly the responsibility of the person selling the home. And then with that, I do want to thank you for your time. Mortgages are confusing, they're difficult, but if you just take it step by step by step, figure out what you want to do and what you want it and how you need to obtain it, it makes the process a lot easier. Thank you very much, and I hope you have a great night.